when you're headed into a recession and interest rates are going up and you want to sell, a seller may consider a 5% reduction.
Right.
I don't know what his basis is, but if he's about to get a $2 million check and he's like, okay, now I'm going to get a $1.7 million check, but if I don't take this and I wait another 2 months, rates are going to go up even further.
Right.
Or if we go into recession, it's going to depress pricing. He may think that's a great opportunity to get rid of that property and get that money in his pocket.
Welcome back.
What is happening?
Man, okay, so this week's episode of How to Invest in Commercial Real Estate, it comes at a good time. So the Fed is meeting again at the end of July.
Next week.
And what are they going to do?
Everything's pointing to another 3/4 point raise in interest rates.
Which is huge.
And they just did a 3/4 point back in May, so that's a 1.5 in 2 months.
They thought it might be a full point, right? Now they're backing
still,
off to,
well, it still could be. Could
yeah.
still be a full point.
Well, and it went up 75 basis points last month. It could easily do it again next month.
The next one is in September, and they think there may be a 0.5 point increase in September. So what we thought we'd do the show on today is that we're getting calls from investors saying, what is the prognosis? What's the outlook? How is this affecting your acquisition strategy? Mm-hmm. We're getting questions from other people that are in the industry thinking, hey, how are you guys navigating this? So today we thought we would take a few minutes to talk you guys through how the interest rates should affect your analysis of a deal, and can you still buy? Can you still get returns in this market?
Yeah, so that's brings us to a great starting point. Is we're typically higher leverage buyers. And what that means is when we go and buy a deal, we're borrowing 75 to 85% of that purchase price from some sort of bank, from some sort of lending instrument where they put a rate on that sum of money.
Yep.
And when 80% of the cost of funds, let's call it, is coming from that bank and that rate is fluctuating like crazy right now, that affects your end cash flow immediately. That's one of the biggest things that is affecting your cash flow is the cost of your capital. So let's just, use a clean, easy deal here. If we're buying a $5 million deal, you're probably getting a $4 million loan. If it costs you 1% more per year, that's an extra $40,000 that you're not going to make on the same deal, right?
Yeah, and we've even got better than a general $5 million deal. We came today prepared with the deal that we purchased in Stone Mountain, Georgia. Yeah. It was one of the last acquisitions for the Criterion Fund, and it's called Stonewood Village. And so we had a bunch of people invest in it, and we want to kind of take that as a case study to show you how much the current interest rate increase is affecting returns on the deals and what you should do about it.
Yeah, and this is a good example because we just closed on this on May 18th. So we've owned it for a couple months now. Everything's going good. It kicked out its first distribution. But if we were to buy that same deal today, it'd look really different.
Yeah, so let's take a look at it. Go ahead, Brian.
No, go ahead.
The deal we bought was we purchased it for $6,457,000. It's a multi-tenant retail center on a good corner in Stone Mountain, Georgia.
8.5 cap.
About an 8.5 cap. And the debt we got on it was prime plus a quarter. And at the time, they had already raised prime like a 0.5 point. And so prime was at 4%. And so our loan was at 4.25.
Great loan.
And that was in May. I think it was it 80% LTV?
80%, 81, but yeah.
A little over 80.
So if my notes are right here, and Braden, you gave them to me, the deal level returns were 12.61.
Yes.
Does that sound right?
Deal level cash on cash with the 4.25% interest rate on our purchase price was 12.61%.
And so how we structure our deals, there's an 8% preferred return. And then there was some split, 70-30.
This is 70-30.
70%. So you got the first 8%, and then the 4.6% cash on cash left. 70% went to the investors. So the investors are getting somewhere between
11-ish.
Yeah, 10.5%, 11%. Okay, so all we did was we went back and we said, okay, today the best case we think interest rate wise on that loan would have been 5.5.
And you said you got a quote for a deal today at 5.5. So that's a today number.
That's a today number. And really, look, prime right now is 4.75, but everybody knows that prime is going to go up next week. So the best quote I could get on a deal today was prime, actually, where we got prime plus a quarter before. Banks are having to get aggressive. We got prime today. Prime I say today, prime as of next week is 5.5.
And by the way, guys, if you're underwriting commercial real estate property for acquisition and you don't know when prime is moving or relatively by how much, you need to get in the know. Because if you had a deal in contract and it just went non-refundable and your rate's not locked, you're in for a world of hurt.
Yeah. I mean, you can't take a 3/4 point hit on your rate and not have your returns impacted, as I'm going to go over right here. So
this is 1.25 hit, right? We were at 4.25. The best we think we can do right now is 5.5.
Yeah, 125 basis points up.
Okay.
Yeah, and it if you go back to some of the lower rates we got, 3.75 back earlier this year.
January, we got that rate.
Yeah, that would have been a 1.75% move in rates. And when you put 1.75 over 3.75, that's almost 50% move in your interest rates, 50% increase in the cost of your debt.
And that's not just for 1 year, right? I mean, these are 5-year fixed rate interest loans,
so
right?
It's a big deal.
It's a 0.75 more expensive this year, next year, the year after that, the year after that, until you can get the opportunity to refinance it. And depending on your prepayment penalty, you may be able to refinance it sooner, but still, that's a guaranteed high rate for a long time.
Yeah. So on this deal, if we take the same purchase price, $6.457 million, and we just put in a higher debt, we go from 4.25 to 5.5.
Yeah.
The deal level cash on cash goes from 12.61 to 10.35. So it's basically a 20% reduction in your cash on cash given the debt number.
It's a lot.
It's a lot, yeah. But I'll say it wasn't as much as I initially thought it was going to be. 10.35. If you're paying an 8 pref, really the sponsor's taking a majority of that hit. The investors are still going to get close to 10.
Investors going from 11 to like 10.
9.8, 9.8, 10. And so the investors aren't taking a huge part of that hit. The sponsor is, if we keep everything the same. But 20% hit to your cash on cash changes the deal. And people have to be aware of that. Doesn't mean you can't buy stuff. It just means you need to know what's happening there with your cash on cash. And you may need to try to retrade the sellers or try to get the sellers to move. And so we did that math for you as well today, where we said, okay, what if we want our 12.61% deal level cash on cash, and we have a 5.25 or 5.5 rate. What do we have to do to that purchase price? And in this case, we'd have to get the seller to drop their purchase price to $6.125 million, or a reduction of like $330,000.
So what did you? That goes from we bought it at an 8.5 cap down to what, about an 8 or up to a 9 cap? What do you have to?
I'd have to do that math. I don't know if I want to do it right here.
Okay.
But yeah, you'd have to get the seller to adjust the cap rate up. The purchase price would have to come down.
Right.
And $330,000 on a $6 million deal is a big retrade. It's 5% approximately. But, when you're headed into a recession and interest rates are going up and you want to sell, a seller may consider a 5% reduction.
Right.
I don't know what his basis is, but if he's about to get a $2 million check and he's like, okay, now I'm going to get a $1.7 million check, but if I don't take this and I wait another 2 months, rates are going to go up even further.
Right.
Or if we go into recession, it's going to depress pricing. He may think that's a great opportunity to get rid of that property and get that money in his pocket.
So is there any downside? So we went through the example and we say, okay, the investors only went from 11 to a 10% cash on cash or so. What's downside? To me, possible downside is you said that a lot of these loans are for 5% or for 5 years. What if interest rates keep rising for the next 5 years and 5 years comes along and now you have to refinance and you have a higher rate? I mean, that's possible downside, right? I mean, I don't think people think 5 years from now the rates are going to be higher than they are now. I think they think they're going to peak and then come back down, but I guess that's a possibility, right?
We have that risk on all of our deals all the time.
I was going to say that same thing.
In fact, you could argue that the rates that we did a year ago at 3.75, 3.5, and 4,
those are the dangerous ones.
That we were essentially at a higher risk because those are five-year rates. Mm-hmm. But if you were paying attention at all, you would have thought, okay, at the end of 5 years, the chances of it being higher than 3.75 is pretty high.
Yeah.
So here, like I think I was mentioning this to you earlier, what's interesting is as interest rates go up, up, and up, I think there's less downside, less interest rate risk in 5 years.
Yeah.
Because, okay, if it does go up, how much more is it going to go up than it's already gone up?
Yeah.
Right.
You're not starting at 3.75, you're starting at 5.5.
You're right.
And so there's a little less risk on the backside if you can make deals work at higher interest rates. And you have the added benefit, if rates come down in the future, you can refinance and increase cash flow without doing anything besides getting a new loan.
Yeah, that's an interesting point. Actually, less risk. If you bought a property 4 years ago and your 5 years is up, 12 months from now, you could be in real trouble, right? 4 years ago, you might be sitting on a 3% loan and you're looking at a 6% loan or something here in the next year or something. So.
Well, and yeah, I mean, looking at that specific example back in 2018, 19, you were seeing high fours, low fives, mid to high fours, and there was still plenty of deals getting done. The problem is when debt gets so cheap, the seller's expectation of their sale price goes so high. And right now we're just dealing with the time needed to kind of get them off that high anchoring point, I think. Yeah. And then to your point, since we're talking about the cost of capital and you say there might be, less risk going into a high interest rate rising environment, an investor like yourself may be willing to take a little less on their money today looking for tomorrow's upside. So that may average out your cost of capital problem with the rising cost of debt, right?
Yeah, let me give you kind of an extreme example if we wanted to look at that. Because I heard at the low of interest rates, the low point of interest rates, people were getting 2.5%, let's say, on a HUD loan maybe or something, maybe a floating rate, 2.5%. Well, to me, that's the ultimate risk because there's nowhere to go but up for your interest rates. And so those people could be wiped out if it goes from 2.5 to 5. You just doubled your cost of capital. And so what's going to be interesting to me is as rates go up really high, the higher the rates get, if you can get deals done and they make sense at a high interest rate, especially compared to the last 10 years, let's say rates got to 6 or 7. And everybody thinks this is the kind of the highest they're going to get. Inflation's kind of coming back under control. Then you have massive upside because if rates ever work their way down, which I believe they will, you'll be able to refinance and cut your cost of capital in half.
Very specific example going back 4 or 5 years ago. I mean, how many deals did you do in 2018 and 19 that you refinanced in 2021 or 2020 when rates started to go down? Right.
There's one example on a big deal we had where we had a rate of 4.75 on $15 million loan and we dropped it to 3. So we saved almost 2 points on $15 million, which increased our cash flow almost $300,000 a year.
Yeah, that was good timing for you.
And we fixed it for 5 years.
That's insane.
Yeah. So these are all things to think about. You need to be more cautious because rates are going up and sellers are not equally adjusting their price. But there still are deals to be had. And once again, I think you can, if you can make deals work with the higher interest rate and still get the cash flow you need, you could be set up for some upside in the future. Also, like we talked about, there are plenty of people that got rates at 2 and 3%, 2.5 and 3.5%, let's say, to be more fair. And if they have notes coming due in the next year as rates are pushing 5.5, 6, they are going to be in a bind, and there could be opportunities to pick things up if people go into foreclosure or go into receivership. Could be opportunity there for us to pick up some deals.
So they may walk away from whatever equity they have in that deal in exchange for the not having the negative cash flow from the increased cost of interest. Is that what you were saying?
Yeah, I mean, you never know. Like you never know anybody's specific situation, but some of these deals, I don't know where they are on their capital structure, but they have to debt cover or they're not going to get loans.
Right.
And so depending on where their cash flow is, if they were at 2.5, 3%, and now they got to go to 5.5 or 6%, it may not work. And so if they highly leveraged, let's say 80, 90%, 2 or 3 or 4 years ago, and now the only thing that makes sense is a 60% LTV, they may not be able to come up with the additional capital to pay off the note that's coming due. So that, we'll just have to see how it works out.
So it seems like generally there should be way less competition in the market now for a deal if it's out there, right?
You think so because you think that there's thinner returns, and so there's less competition. Is that what you're thinking? Or
Yeah, I think deals are just generally harder to get done. I mean, we had lunch with a lender the other day, and they were saying, they were starting to pump the brakes a little bit on multifamily or whatever it was. So, I mean, I think there's just a general tightening and a period of time where people are saying, hey, what is this going to look like in December? I don't know. I'm kind of scared that I don't know what it looks like in December. Maybe we should hold off a little bit.
That's the unknown is the key is when there's uncertainty in the market, people don't have the clarity to move forward or move as quickly. And so, there will be less deals getting done because people are uncertain about debt terms, where the market's going. Are we headed into a recession? Are prices going to fall? Do I really want to be buying at the peak of the market if prices are going to fall? So there's all that going on. Now, there's still a ton of capital out there. So there will be deals getting done, and a lot of 1031 exchange money is out there.
Right.
And at least for the next 6 months, all the deals that have sold the last 6 months, they don't have a choice. If they don't want to pay a huge tax bill, they're going to have to trade into something. What I see, though, is if interest rates keep going up, we'll still see deals for the next several months, but then I think it really slows down after that, after a lot of this 1031 money works its way through the system.
It makes me wonder if the sellers won't adjust their prices for a while because of all that 1031 money.
I think it's going to take time.
There's going to be a lot of all cash deals where people don't care what the interest rate is, right?
Yep.
And so maybe the sellers don't have to adjust so much.
We're selling multiple deals right now, right? Like you're selling an apartment deal. We're selling some pad sites in Plaza West. We're selling a single tenant deal in Dallas, and I haven't dropped my price once. I mean,
right? We did on our multifamily portfolio. It hasn't closed yet, but we did give them a little bit of a discount given the size of the deal and the interest rate impact.
Gotcha.
But not too much. Something we both felt the pain a little bit, and that seemed to be a good middle ground.
Like Bob says, that's how you know you got a good deal, right?
Yeah.
When both sides are upset.
Well, that's a lot of information to kind of unpack there. You can do your research. A lot of this is public information, at least on the Fed when they meet, what the probable rate increase is, the history of where prime has been. But the great news is you don't have to be an expert in all of that, right? Because you can go to our website, thecriterionfund.com or Precision Equity, and you can sign up for our investor list. And then when we have opportunities that work, we send them to you. You don't have to worry about what the interest rate is because we've kind of pre-vetted it, right? We bundle it in this nice little package. We send it to your email, and then boom, we close the deal.
Yeah, and one of the things I want to challenge people to do is instead of saying, it isn't going to work, interest rates are going up, recession's coming, is start asking yourself, how do I win? How do I make a deal work? How do I get the numbers to work? Because there are opportunities that are out there in every single market. Rising interest rate market, recessionary market, hot market. There's always a deal to be had. But if you don't believe that, you're not going to be out there looking, and you're not going to task your brain with trying to figure out what scenario can I make this work? Like in this situation, the new debt's this. How do I get the seller to give me $330,000 off that deal so I can get the same return for the investors that I had pre-interest rate hike? So as long as you're trying to solve problems, you're going to find an opportunity to buy in this market and in a market 6 months from now and a year from now.
I agree with that.
It's great advice. Well, if you guys don't have anything else, we will see these guys next week.
Yep. Thanks, guys. Tune in next week.